Welcome to the Retirement Guide Podcast. I'm your host, George Jameson, owner of Capital Wealth Group, a flat fee only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement. So let's get started. Hello, everyone, and welcome to today's discussion on how to minimize taxes on your retirement savings. As you approach retirement, it's crucial to understand the various strategies available to optimize your tax benefits and ensure your savings last as long as possible. So let's dive into some effective strategies to help you minimize your tax burden now and during retirement. So number one, understand your retirement accounts. First, it's essential to understand the different types of retirement accounts and their tax implications. First, you have traditional IRAs and traditional 401ks, which are funded with pre-tax dollars, meaning you get a tax break when you contribute, but you'll pay taxes on withdrawals in retirement. On the other hand, you have Roth IRAs and Roth 401ks, which are funded with after-tax dollars, but withdrawals are tax-free, often during retirement. Then you have taxable accounts, which are taxed in various ways depending on the investments. So knowing how each account is taxed can help you plan your withdrawals strategically. And number two, leverage the Roth IRA advantage if possible. One of the most effective ways to minimize taxes in retirement is to leverage the benefits of a Roth IRA. Since Roth IRA withdrawals are tax-free, it may be beneficial to convert some of your traditional IRA or 401k to a Roth IRA, especially if you expect to be in a higher tax bracket in the future. This strategy allows you to pay taxes now at a potentially lower rate and enjoy tax-free income later. So what is a Roth conversion? A Roth conversion involves moving funds from a traditional IRA or 401k to a Roth IRA. You'll pay taxes on the converted amount in the year of the conversion. Future withdrawals will be tax-free. So what about timing the conversion? Consider converting during years when your income is lower, such as early retirement, before required minimum distributions start, and even possibly before you start Social Security. This can help you stay in a lower tax bracket and reduce the overall tax impact of the conversion. However, keep in mind, Roth conversions are not for everyone. And then number three, plan for required minimum distributions ahead of time. So once you reach age 73, you must start taking required minimum distributions, called RMDs, from your traditional IRAs and traditional 401ks. These distributions are taxable, and failing to take them can result in hefty penalties. So depending on the size of your IRA and 401k and how much money you need to live on, it's important to plan ahead before you turn 73. You can manage these RMDs in several ways. If you know that you will most likely need the full RMD requirement at 73, then there may not be any planning need at all. However, if you only need a portion of your RMD to live on, you're most likely paying more taxes than you need to be. This is especially true if you and your spouse have large IRAs and 401ks. If so, it could potentially put you in a much higher tax bracket later on in retirement without proper planning. If this is you, you may consider converting some of the traditional IRA funds to a Roth IRA before you reach that RMD age, or you may start taking contributions from your IRA before RMD age. Another strategy is to use qualified charitable distributions, called QCDs, to donate your RMDs directly to a charity, which can satisfy your RMD requirement without increasing your taxable income. So number four, asset location. Asset location is different than asset allocation. It's a tax strategy that can help investors reduce their tax burden and potentially increase after-tax returns. Here are the key ways asset location can help minimize taxes. First, placing tax-inefficient assets in tax-advantaged accounts. So in general, you will want to put more investments like bonds and REITs that generate regular taxable income in tax-deferred accounts like traditional IRAs and traditional 401ks. This allows the income to grow tax-free until withdrawal. And then number two, holding tax-efficient assets in taxable accounts. So in general, stocks, index funds, and ETFs that generate either no dividends or qualified dividends, and long-term capital gains, which are better suited for these taxable accounts. These benefit from preferential tax rates compared to ordinary income rates. You can also use municipal bonds or bond ETFs in taxable accounts, since their interest is often tax exempt at the federal level and sometimes the state level. Note you still may want to hold taxable bonds in taxable accounts, depending on your tax bracket, your income needs, and to help with periodic rebalancing. So maximizing tax-exempt growth. Assets with the highest growth potential are ideal for Roth IRAs, as all growth will be tax-free upon qualified withdrawals. So taking advantage of the different tax treatments. Interest from most government and corporate bonds are taxed as ordinary income, all the way up to 37% at the highest tax bracket, while qualified dividends and long-term capital gains are taxed at lower rates, such as either 0, 15, or 20%. All of this can enhance your after-tax returns. Proper asset location can potentially increase after-tax returns by 0.2% to 0.5% annually, according to some estimates. By strategically placing investments in the most tax-advantaged accounts, investors can minimize their annual tax burden and potentially keep more of their investment returns over time. However, again, it's important to note that asset location should be implemented in conjunction with proper asset allocation to maintain the desired risk-return profile of your overall portfolio. I plan to do a separate episode just on asset location and go into more detail because there are other factors to consider depending on your situation. One other strategy I forgot to mention before we move on is tax loss harvesting in taxable accounts. I plan to do an episode just on tax loss harvesting in future episodes. Then number 5, utilize tax credits and deductions wisely. Even in retirement, you may qualify for various tax credits and deductions. For instance, the IRS offers a larger standard deduction for individuals aged 65 and older. You can also take advantage of deductions for medical expenses, charitable contributions, and certain home improvements. By itemizing your deductions and leveraging available tax credits, you can reduce your taxable income and lower your overall tax bill. However, keep in mind because of the large standard deduction, it may be difficult to itemize every single year. So you may need to work with your CPA or your financial planner to help decide which years or year you may want to itemize, such as giving a large amount to charity one year and none the next. So number 6, consider state tax implications. Where you live in retirement can significantly impact your tax situation. Some states do not tax retirement income, while others have favorable tax policies for retirees. States like Florida, Texas, Tennessee, and Nevada have no state income tax, which can be beneficial for retirees. If you're considering relocating, research the tax implications of your potential new home state to optimize your tax situation, if possible. However, make sure you look at all the expenses where you will be moving. For example, Florida, which doesn't have any state income tax, but their homeowners insurance can be very expensive. And next, number 7, income distribution strategies. This one's very important. Implementing a systematic withdrawal strategy can help you manage your tax liability. By carefully planning the order and timing of withdrawals from different accounts, you can minimize the impacts of your taxes over time. For example, you might withdraw from taxable accounts first, then tax-deferred accounts, and finally tax-free accounts like Roth IRAs. But note, this is just an example, and everyone's situation is different. This is where financial planning software and working with a fee-only advisor can really help you make informed decisions. And then number 8, you may want to seek professional guidance. Taxes can be complex, and retirement tax planning is no exception. Consulting with a fee-only financial planner or tax professional can help you navigate the intricacies of tax laws and develop a personalized strategy to minimize your overall tax burden in retirement. So in conclusion, minimizing taxes on your retirement savings requires careful planning and a strategic approach. By understanding your retirement accounts, possibly leveraging Roth IRAs, definitely planning for RMDs, investing tax efficiently, utilizing tax credits and deductions, considering state tax implications, and implementing effective income distribution strategies, you can possibly reduce your tax burden and maximize your retirement income. Thank you for joining me today, and I hope you found this discussion helpful, and have a great day. Thank you for tuning in to this episode of The Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. Visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.